The U.S. economy lost 92,000 jobs last month, far below the gain of 50,000 jobs experts had predicted, no doubt also impacting those market numbers.
Negative 92,000 jobs just in February alone. Economists expected plus 50,000, but we got negative 92,000. That is not a miss. That is a collapse. Unemployment just ticked up 4.4%. Oil is still sitting at $80 a barrel. And the market opened red, and it was a brutal open. However, we managed to recover. I told you guys last night that this was coming. I told you not to trade before 8:30 a.m., and I told you to wait until the dust settled. Now the dust has settled, and I'm going to show you exactly how I positioned me and my team this morning as option sellers. Now, before we jump into anything, this is a real account with real money. Here's what I'm sitting at right now after this morning's numbers. We're currently sitting at about minus 0.49% on the day, which in hindsight of things is not bad at all, considering the NASDAQ is down almost 1%, the Dow is down over 1%, and the S&P is down over 1%. So we are doing way better than the overall market. That is great news. And if you guys want my exact entries and exits as soon as I take them, you guys can go ahead and claim Founders Access at $199. That will get you a lifetime membership in my WAP group. So this morning we opened up two positions, one being an Amazon cash secured put at a 210 strike, which we got paid $516 for entering this contract. And the second is going to be a NVTS leap, which we already printed on these leaps a couple weeks ago, but we're going to re-enter them here in hopes of a bounce on Monday. So let me tell you guys why this jobs number is different from a normal miss, because negative 92,000 is not just weak. It's the worst reading we've had in 4 months. We've got oil at $80 because of Iran. You've got 15% global tariff potentially going live right now. You've got unemployment ticking up. At the same time, jobs are being cut. And there's a word for this combination. It's called stagflation. We have weak growth, high prices at the same time. This is the hardest environment for a Fed because they can't technically cut rates to stimulate. Inflation is too high, and they can't raise rates to fight inflation because the economy is weakening at the same time. They're basically stuck. When the Fed is stuck, the markets will stay volatile. And when markets stay volatile, implied volatility stays elevated. And as I mentioned in my last video, premiums stay fat and juicy, which is what we like. As option sellers, we get paid more when there's higher implied volatility. So let's talk about what this actually means for your cash secured puts right now. There's 3 things. Number 1 is know which sectors just became landmines. Look at what's leading the decline this morning. We have financials getting hit hard. Banks hate stagflation. Weak economy means more defaults. Sticky inflation means the yield curve stays ugly. So if you guys are planning on opening up new cash secured puts on financials or industrials this morning, you guys should probably wait. You don't need to be selling puts into a falling knife, as I mention all the time. You guys don't sit under a falling knife and try to catch it with your face. We wait for the sector to stabilize, and we wait for the IV to peak and to start coming down. Number 2 is know where the opportunity actually is. Energy is green this morning and stables are holding. Why? Because oil's at $80. And this is bad for airlines, which is why we saw American Airlines take an absolute dump this morning of almost minus 5%. And this was a recovery. We dropped to all the way down to $11.11. So number 3 is the volatility spike is your friend, guys, if you're patient. Here's what happens after a number like this gets released. The VIX spikes at open. And what did we see at open this morning? Well, we saw a massive VIX spike up to 2860. Premiums are the fattest, but the first 30 minutes are also the most dangerous for traders, which is why I told you guys in my last video to wait till after 10 o'clock or even 10:15 to open up any new trades. We see crazy wild swings in the first 30 minutes. So you set your strikes, you wait for the volatility to peak and the first wave of panic selling to exhaust itself. Then around 10 o'clock, you look for an entry on the strongest names in the strongest sectors, which is what I did today with Amazon. That's when you sell the put. That's when you guys collect your premium. And that's when you get paid for being the calm one. I'm going to show you what this looks like in practice in real time. So here's a stock, Amazon, as I already mentioned a couple times. Amazon is very weak right now. We are still trading way under all-time highs of about 17%. So it is technically still in a correction territory on a Mag 7 name that is doing great revenue. As you guys can see here with the $210 strike on Amazon that expires March 27th, the open interest is 1,100. That is extremely, extremely elevated. So I'm looking at a 210 strike, which means if Amazon does drop below $210 by March 27th, I am required to buy 100 shares unless I want to roll. But I am completely fine buying 100 shares of Amazon at $210, but I don't think it's going to get there. I think Amazon is going to push up into the 230s within the next couple of weeks, which is why we also have a leap trade on Amazon. So you're looking at about a $21,000 collateral. You're going to earn 2.46% return on your money in just 21 days. That's under 30 days. Annualized, you're looking at 42.8%. That is phenomenal results. Here's the bigger picture. I want to leave you guys with this. The S&P is down for the week. The NASDAQ is down for the week. Jobs report just came in negative. Oil's at $80. Tariffs are being thrown in the air again. Iran is in the headlines. And Ahmad Capital, we are still targeting our 2 to 5% a month. And it's not because we're lucky, and it's not because we have some secret information that nobody else has, but it's because we're on the right side of fear. When retail investors panic sell, they drive premium prices up. When headlines cause volatility, premiums go up. For us as premium sellers, we love to see that. When the VIX spikes, we get paid more. It's that simple. We are not fighting the market. We are harvesting money from the market. That is the whole wheel strategy. That's the business we're running. We're not here to gamble. We're here to run a business.